Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of September 29th, 2024. And in this week's episode, we are going to talk a little bit away from trading and go a little bit more into the investing side, something we don't normally do. But we are going to take a look at retirement savings and wait, what? You have to save for retirement? And I guess depending on what type of retirement you want to have, depends on when you start planning for that. So we'll jump into that topic of how the heck do you start doing that and when the heck should you start doing that. But before we hop to that, I want to give a shout out to our Discord, link in the description below. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe to us, and if you can't find it, let us know and we will get it there. But let's hop to this week's episode. Viper retirement. This is something that when I was much younger and fresh out of school, I was like, oh, yeah, retirement. That's something I'll do someday. I'll worry about that when someday later comes. And more recently, I felt like someday later was getting closer and closer to coming. And I said, boy, I better start figuring out this retirement business. And as I kind of went through that, I thought to myself, gee, I should have figured this out a long time ago, much longer ago, because I felt like I would be a lot more further off ahead. So this episode is really dedicated to anybody out there that is kind of in that phase where you're like, oh, retirement, I'll do that someday. This is future you coming back and saying, hey, pay attention to this because starting now is a pretty good thing to get going.
Yeah, absolutely. And we'll call this episode Even Red Bananas Need to Retire. So that is because this is inspired by, I don't know, maybe one of our first community adjacent requests by somebody who I met out on my travels. And if he ever pops in the Discord, he will be recognized with his red banana profile picture. I mean, similar story. I mean, even speaking a little bit from what I assume his perspective is based on the conversation I had with him. It's just one of those things of you hear about all these things, you don't worry about it, you don't focus on it, or you aren't in a position where you have a particular job that helps enable these things for you. Sometimes we take for granted the systems that certain jobs might put in place for us, like a 401k or anything like that. And it's just one of those like, oh, I just send some of my paycheck into that. And we don't think about, that's not a lot of people that, there's a lot of people that want to still have access to these things, but, need to have more initiative to set it up themselves. And they acknowledge this is important and I should figure this out. And so that was kind of where this came from of, how do I start preparing for retirement and demystify the process of doing that? Because honestly, it's extremely intimidating and it's needlessly intimidating because everything is so accessible, which is what I think we're aiming to lay out here tonight.
Yeah, so let's hop over to kind of the first thing where I call it, let's cover the basics. And so I'm going to bring up here a couple of what I consider the basics. I guess you could say what Blockhead Traders considers the basics because I believe Viper is in alignment here with me. And so the first thing I want to call out is there's numbers here. And these numbers are what I would consider and we would consider the prioritization of focus on this. Now, that doesn't mean that you can't advance to number 2 until you finish number 3, and it doesn't mean you can't start number 3 until you finish number 2. To each of these pieces, you can kind of build and grow in parallel, but if you have limited funds or limited approaches, I think you'll see the biggest benefit if you kind of tackle these things in these priorities. And what we are not going to get into in this episode is some more complex retirement plans or retirement strategies. This is really just a bare bones basic, hey, I get paid money occasionally. I would like to get paid money after I'm done working for people. So what's kind of the bare minimum thing that I need to take into account? And so a couple of these basics, which you'll notice, what the heck does that have to do with investing? Number one, live below your means. This seems kind of silly, and you've probably heard it before, but this is something that I will say I didn't do super well, but I actually did kind of try that. And what that means is find a lifestyle that is, slightly less than whatever your income actually is, and be comfortable in that lifestyle. And what I would say is, as you get advancements or raises at whatever jobs you're doing, try not to increase your lifestyle linearly to that, right? Try to take that extra money and use that as, oh, hey, look, here's some extra funds that I can take and put into bullet points 2, 3, or 4. And so that kind of the mentality of not running all of your money out of your paycheck into some sort of expense every single month is what I mean by live below your means. That way you are carving out extra money that you can actually deposit and invest in the future. So if you don't do that, then there is nothing to invest.
Yeah.
So
it's quite simple as can't save it if you don't have it. It's gone. So.
Yeah. So that's why it's the most important thing, because 2, 3, and 4 have no meaning if you got nothing to put in them. All right. So bullet point number 2, emergency cash savings. Now, why the heck do you want to put that here? Because you know what? The craziest things will happen in life. It could be a sports injury for one of your kids. It could be a car accident. It could be a piece of equipment at your house breaks down and you have to fix it. Could be something gets, lost or damaged, or you never really know what might come up as an emergency expense. And you want to be able to be liquid enough to cover that emergency expense without really stressing out. And so, they generally say, hey, target 3 months of your expenses. So, if you go through your monthly bills and you're spending somewhere on the order of, $6,000 a month, $4,000 a month, multiply that by 3, and you should have that sitting in a savings account somewhere. So the first tip I would give you is find a high yield savings account. These do exist now, especially with interest rates that have been kind of raised. You're no longer really looking at 0.5% savings account rates. You can find something in the 4.5%, 5% rate. Typically, it'll be like an online bank, not a brick and mortar bank. Brick and mortar banks are probably going to chop off about 1.5%, 2% off of the best rates you can find in an online bank. But in a connected world like we have today, any banks, you can keep your brick and mortar bank. I have a brick and mortar bank, and I have an online high yield savings account. In my brick and mortar bank, I simply put my routing number and my account number of my online high yield savings, and I can flush out, sweep out money into that. I can pull money back from that, all within 24 hours. So it is relatively accessible for any sort of emergency fund. And the reason you want to do this is generate income for it sitting there. Don't put it in a checking account with no interest and wasting away, right? We want to squeeze every little bit of income out of every little fund that we're squirreling away. Number 3, an HSA or a health savings account. Okay, you're probably scratching your head. You're like, okay, you're talking about retirement here. We've gotten through bullet points 1, 2, and 3, and you haven't mentioned retirement. So what the hex does an HSA or health savings account have to do with retirement? Well, like I kind of mentioned in the previous bullet, it's all about maximizing value out of the money that you have today. And so what exactly is a health savings account? A health savings account is basically a savings account that is what's known as triple tax advantaged. The money that you deposit into a health savings account is not taxed. The money that you grow in a health savings account is not taxed. The money that you extract from a health savings account is not taxed. There are no taxes going in, no taxes while it's in there, and no taxes going out. You might say, well, why don't I put all of my money in there? This sounds amazing. Well, there's two reasons. First reason, the expenses of taking it out have to be for some medical related cost, whether or not it's a doctor, a prescription, a dentist, anything like that, physical therapy. It has to be related to a medical expense. The other reason is there is a limit that you can put into every year into an HSA. So why does this have to do with retirement again? Well, first of all, it's going to lower your immediate medical bills because you can now pay for all those medical fees without any taxes. So the money you pay with it, you do not have to withhold taxes from. Cool. What else does this mean? Well, guess what? HSAs don't go away. You grow them over time. So the money that you put in today, as long as you don't spend it, will be there tomorrow and the next day and the next day and the next day. It doesn't expire. And do you know what one of the biggest expenses is in retirement? Spoiler alert, it's healthcare. So this is effectively lowering your costs today and squirreling away money for the future. And the contribution rate for HSAs is not dependent on what else you contribute in an IRA or other savings vehicles. It has its own contribution limit. So that is why this is number 3, because it can reduce your tax exposure today. It can reduce your medical bills today, and it can be there for you, growing tax-free and withdrawn in the future when you retire tax-free.
Yeah, and honestly, I mean, of this whole list, and I guess part of this is because I'm not in retirement yet, but of this whole list, like the HSA is by far my favorite thing, my favorite thing in the world, and it's something that I only started with honestly like 4 or 5 years ago, and that's just because previously I had a somewhat tax advantaged health account that, but it was all like within a year. You had to use it or lose it and it was gone. And then you started the next year. So the HSA was just a huge eye opener to how beneficial it is because of all of the triple tax advantages, as well as the fact that it just is money that goes with you. It stays with you. You contribute the maximum or whatever you want to contribute, and you have that money forever. And then once you get to retirement, it just kind of flips into a retirement account, and you can withdraw it for non-medical expenses. So it's everything about an IRA, which is the next bullet point, but it has that extension arm of accessibility now, which is really cool, I think.
Yep, it definitely is. And that brings us to bullet point number 4, which is the first item on this list that actually has the word retirement in it. And that is an IRA or individual retirement account. They will come in 2 flavors, a traditional and a Roth, and we can touch on the difference, but it's not so important. There are many other different types of retirement vehicles out there, but we're keeping this episode simple because slow and steady and simple is really what is kind of the barrier to entry. We want to make sure that you guys understand this is not hard stuff. It's quite simple, and it can be very much a set it and forget it. And so an IRA is exactly what it sounds. It's an individual retirement account. You can deposit money into that account to be saved for retirement. Now, the big gotcha is once it goes in, it should stay there until you retire. There are penalties if you do early withdrawals. So that's also why it's number 4, right? As you go through life, there are things that will need expenses and be able to withdraw monies. Number 1, 2, and 3 all allow you to withdraw money now to pay for things. Number 4 does not. And that's why it's down here on the list as the last one, but it's the one that is most geared towards retirement. So the only difference here between traditional and Roth for simplicity purposes is one is tax-free going in and one is tax-free going out. So it's not like an HSA where you're tax-free on the input, the gains, and the output. On an IRA, you're tax-free in 2 of those parameters. So you're either tax-free going in, tax-free growth, and then you are taxed going out. That is a traditional IRA. The flip side of a Roth IRA is taxed going in, it grows tax-free, and it is not taxed coming out. So pick your poison as far as which one you want to approach. Some people actually do both. It is important to note that the contribution limit to an IRA annually, which I believe is $7,000 right now, is $7,000 to an IRA. It is not $7,000 to a traditional and then $7,000 to a Roth. So you can have both, you can contribute to both, but the IRA limit per person is a accumulation of both of those together.
Yeah. And the only thing I'll say to this is I probably personally prioritize, especially in the scenario we're talking about here, where you're just kind of on your own getting all this set up. I personally kind of prioritize the Roth over the traditional because that taxed going in, it doesn't mean you get taxed when you make a deposit or anything like that. It just means you're using money that you've already paid taxes on. So you earned your wage, you paid taxes on your income, and so now that money you can deposit it in the account, and it's already taxed because it was taxed as income, and therefore it goes in just like any deposit anywhere. So I probably give that one a little stronger of a priority, but there's still a thought process to go through because obviously in the traditional, the fact that the money's going in untaxed, it means that it's coming straight out of before your income tax. And so there are certainly beneficial scenarios to think through with that, depending on what your income is, to pause that taxation until later and actually lower your income amount because you're depositing that into there. But there's a little bit more setup to that traditional thing. So that's why I would, kind of probably give a slight edge to Roth in the particular inspiration of the setup here.
Yeah. And the one thing I want to mention here, because at the very top, we mentioned slow and steady wins the race. And what I mean by that and why I want to put that up there is because a lot of people think, oh, you know what, let me go ahead and cover all this and buy these Christmas presents or buy these birthday gifts or, do this, do that. And then if I've got some leftover money, then I'll go ahead and put it in my retirement account. I would strongly, strongly advise against that approach. I believe it is much more better to take a dedicated amount, so divide up what you want to contribute in a year to either your IRA, your HSA, all these things together, divide it out by your pay period, whatever the frequency is that you pick up a paycheck, and allocate a certain percentage or dollar amount out of each of those things. That way you never get used to seeing that money. It just constantly goes into that drip of your HSA, your retirement account. And that really helps kind of build that repetitive muscle memory of this is just a thing I do versus, oh, well, just this one time I'm gonna go out to this nice fancy dinner and you know what, I'll catch up next month. Or, it's been a while. Let's stop our contribution for 3 months and just take this extra vacation, right? I mean, there's nothing really wrong with that, but it's kind of like dieting or things like that, where you really have to be disciplined to build that and strengthen those muscles and get the real results that you're after. So that slow and steady, I really want to give a call out there to say, commit to that, pencil it down. And I know when I mentioned live below your means, one of the things you could even do is say, hey, you know what, when I do a great job at whoever my employer is, or maybe I switch employers and I get a particular pay raise, whatever that delta is, maybe just divide that up and put that into your drip of your savings accounts for the future.
Yeah. And one of my favorite ways to get into this mindset when I was trying to build up just how to do that, because in practice, especially depending on your personality, it can be very difficult to hold yourself accountable to that sort of discipline. But never underestimate the power of tricking yourself. Because one of my favorite things to do as I was trying to ramp up is, exactly what you said, like just immediately cut it out, have an automatic transfer, something that is completely out of sight and out of mind. And so for me, one thing that I did was if I wanted to ramp it up, and I was pretty sure, we were living below the means and whatnot, I would crank it, and I would crank it what I thought was too far, because that would really showcase whether or not where our means were essentially. And so and by crank it I mean like an auto transfer of like I get paid bi-weekly, so every Thursday or every Friday do an automatic transfer from checking account to this other account, and then I would just see if I feel it, and if it was doing that for a week, 2 weeks, a month, and I'm not feeling it, then fantastic, it worked. And then if it was too much and it's like, no, we're just barely squeezing paycheck to paycheck, then okay, I cranked it up too much and dial it back a little bit. But everybody's going to have their own, I mean, maybe you're just a very strict, rigid person that, doesn't have a problem with that, but be creative and try to force your own hand. But if need be, just have it be a separate checking account or a separate savings account that's just a staging area where you automatically transfer it there, just to make sure that you can ignore it and then all of a sudden chip it off in one, lump sum, or, whatever. You can manage it from there, but trick yourself if need be is the main point.
All right, Viper. So that covers, they're probably all bored. They're like, okay, great. That's what everybody's always told me. So I always get confused when it's time to go do something. There's all this, TSLA, VTI, VOO. What is all this stuff? How the heck do I actually do something? I've set aside my money. I've dripped, but how do I pick? How do I know what to pick? What if I pick something wrong? What if it goes against me? Like how do I do it?
Yeah. So let's make it all really real right now and just walk through everything we're about to walk through is just one path you could take. Obviously there's tons of different paths, but the parameters of this exercise are ease of access. You're doing this all yourself. And you also don't want to treat this like a trading account. You just want to set this up to set yourself up later for retirement. So let's just start right at the basics. So let's hop in here to where do you go? And so there's there's lots of different places you could go. There's two that I'm going to call out. One of them is right here at Fidelity. So this would be more of your traditional brokerage experience. And I mean, it's really as simple as hitting the homepage here, fidelity.com, and just say, hey, I want to open an account. And then they say, cool, what do you want to open? Like I said, Roth IRA was the path I went down. And then they just kind of walk you through here of you click on the Roth IRA option, and there's just a whole sequence of, hey, are you already a customer? No, I'm not. And so then you just it's, I went through this a while ago, but just standard application stuff, walk through it, create it. And in the end, you have yourself a shiny new account that you would go to fidelity.com, you would log in, and you would see it just like a bank account, just like a brokerage account. If you already have a brokerage account that you trade in at Fidelity, you're just going to see this as another line item where you'll see both of those accounts next to each other. So it's really that simple just to set it up and have it established, doing all of your paperwork here to get it going. And then once you have it going, there's a number of different things. You could just trade. You could trade stocks in it once you set up, the linkage to your bank account and put a deposit in. Set up an auto deposit, if that's part of your strategy. But once you're in it, you can make purchases of pretty much anything that's listed in the stock market. But particular because of what we were saying, we want to go with, this is a pretty hands-off situation. Just putting money in doesn't do anything. There's usually not any interest or anything like that. You do have to make a purchase of something. And so it can be, even as ecosystem or whatever managed. You can see here that they have these managed retirement funds. And so these are just an example of the most hands-off possible. And so basically you can look at this table here, date of your birth, and this is only going up to 63, 67, but I know these funds continue up the chain here. So you can find a full list. But basically what these are called mutual funds. And you can see the tickers over here in the parentheses, FMRTX, FMRAX, etc. And all these they're just saying if you were born between the years 1948 and 1952, then your retirement age is going to be around the year 2020. So this is just saying this is a Fidelity managed retirement fund, and its target retirement date, its target date of starting to have access to these funds is the year 2020. And so on the right side here, you can see how they divvy up the funds. And this is beyond what you need to worry about. All you would do is have your deposit put in. You would go search FMRTX, and you would just make a purchase for however many shares you could afford with what you deposited, and then you're done. You check out. But just because it's good to know what your money is doing, on the right side here is just showcasing what they do with these different funds. Why do you have a 2010, 15, 20, etc.? And this is just showing how they change the asset allocation within the fund. So you can see, if you were retired in 2010, you're well retired by now. And so you're going to have majority of those funds are going to be in bonds, because that is just a very stable, still interest earning, but a very stable investment. You have a very small position in equities because you are in retirement. You want to be risk off the closer you get to retirement and as you go into retirement. But if you're not retiring until 2035, well, in that case, they're going to have a bucket of assets that's 31% allocated to the U.S. equity market, the stock market, some foreign investments, and 47% bonds. And so that's just why these things are different, because they are targeting different ages and risking off as you get closer to those years. So this is a very easy, very basic place to start, is deposit funds. Grab one of these that's as far out as wherever your retirement age year is going to be, and then never forget about it. And buying it is just as simple, I would say.
Yeah, let's buy something. So let me go ahead and flip over, and I'm going to take you into where I have my IRAs, which is Charles Schwab. So I'm just going to come in here, and we're going to log into Charles Schwab. This is just like logging into a bank that you guys have. You'll get a beautiful two-factor authentication. Most of this stuff is configured depending on your broker. Punch in our multi-factor code, and that's going to take us right into our account. So just like a bank account where you have multiple accounts, you're going to want to go ahead and you're going to want to choose the bank account that you want to trade in. And so I want to use my IRA account. So I'm going to come into my IRA account. Now, it's as simple as opening up the buy, or what they call the snap ticket. You enter the ticker symbol of what you want to buy. So one of the things that I invest a lot in is a thing called VTI. It's the Vanguard Total Stock Market ETF. So it is a low ETF fee that basically tries to track the entirety of the stock market. So it has representation across all sectors. So it's currently trading at $282.45. You say, do you want to buy it? Do you want to sell it? Do you want to, which one of those things what do you want to buy? How many do you want to buy? Do you want to buy 1, 2, 3, 4? Let's go ahead and buy 1. You get to choose what type of order you want. I'm going to go ahead and choose a market order. So it says, hey, you're going to buy one of these things on a market order. We estimate this is going to cost you about $283. That's roughly what it is trading at. And you can say, place this order. Order received. Done. The Viper, that's it, man. That's as easy. If you can buy something on Amazon, you can buy something in your IRA. It really is that simple. In fact, it's even simpler because you don't have to enter in your credit card information or your shipping information. You just log in and say, buy this, and then boom, there it is in your account, executed when the market is running.
Yeah, absolutely. And so what we saw there was obviously setting up at Fidelity. You were using Charles Schwab. A little more retail focused. I just was going to call out Robinhood as one potential place you could go. You can open a Roth IRA. You can open a traditional IRA. Obviously, along with you have all the trading accounts at Robinhood. The one thing to think about is various benefits. Now, obviously, Robinhood is very retail focused, so they're going to have sweet deals that might be too good to be true. There's a lot of you need to look into just anything you would due diligence on anywhere you put your money. But the one reason I wanted to call out Robinhood is because of that retail focus, because they are trying to be a little more aggressive in capturing that capital. They do run some pretty decent deals from time to time, especially when we're talking about being the self-starter in this, not having, that corporate company match program or anything like that. And when it comes to Robinhood, other places probably do it too, other retail apps. But when it comes to Robinhood, they run regular matching programs. And so they'll have, limited time offers or whatever of doing a 1% match where you go ahead, you set up a deposit and they'll match it. And so that can be a potential source of extra money to put into the account. Certainly if you work somewhere where there is a company match, that's one of the guidances is at least put in whatever they're going to match, because that's literally free money. And so capturing that wherever you can. So that's an option on Robinhood as well. But everything else works exactly the same, especially if you've traded on Robinhood. It's going to function exactly the same. You just click over to where your IRA is, and then you search whatever ticker you want, and you order it, and you submit it, and whatever. So you can play around with it. It's as simple as what Sprocket did, but you can also set up regular buys. So if you are, let's say, so that VTI was trading at $238, Robinhood does partial shares of VTI. I'm not sure. Brokerages may vary as to who does partial shares. But whether it's partial shares, whether or not, if you're putting in X amount of money a week and you're going to be able to buy a share in X amount of time, you could set up a regular recurring buy. So then you really don't have to think about it. You just put the money in, your recurring buy is going to pick it up and take care of it. And then it's even more hands off and you're off to the races. So in this case, market orders, I think, are definitely preferred. Limit orders, you don't really need to worry about getting the price exact, the entry exact, because you're not seeing this for many, many years to come. So I don't think you're going to fret getting slipped 1 or 2 cents on your entry order. So definitely don't worry about what a market limit order is. Just take the market one, in my non-professional opinion.
Yeah, one thing I would add, particularly because you called out mutual funds. Mutual funds are slightly different when you put the order in, and I think it's different in a good way, because what you contribute to a mutual fund is a dollar amount. So there's no such thing as shares to buy in a mutual fund. You contribute a dollar amount, and it goes at the end of market close. So if the example that Viper had pulled up of the different Fidelity managed accounts, you put that ticker number in, and it basically just, there is no buy. It just says contribute or withdraw. So if you have money in that fund, you can withdraw it. If you don't, you say contribute and you pick a dollar amount, $10, $50, $100. You don't have to worry about how much is it trading at or anything like that, because it's all fund based.
It's that simple. Put it all together. What's kind of your very high level architectural setup?
Yeah, so I like to be able to keep things somewhat relatable to people. So people are like, oh, that's cool, but what do you do? And so I've just jotted a couple things down here, and this is actually kind of the order that I do things in. I keep a high yield savings account. I happen to use a bank called Live Oak. My percentage rate, my percentage rate that I get in there does vary over time. So when I started this thing, I think it was like 2% when interest rates were between 0.5%. Most recently, believe it's been at 4.75%, and that's where my emergency cash is sitting, and it's linked to my main bank account for my brick and mortar store, and then it just sits in there growing at that interest rate. And it's available anytime I need it. Now, I keep, once that dollar amount goes over that 3-month thing, it spills out into either my brokerage, my main brokerage account. So I can then say, okay, let's just trade with that, which isn't listed here because my brokerage account is not really intended for retirement, but that's kind of where it spills into. The next thing I do is I divide up my maximum contribution that I can put into my HSA, and every paycheck I take whatever that division is from the maximum contribution divided by the number of paychecks, and every paycheck I deposit that much into my HSA. My current HSA provider, ironically, Viper, I am ditching this week because they changed the way that they do their investments, and I don't really like it. I want the brokerage experience, and they got rid of that. So I actually went out to look for where can I get an HSA that gives me my brokerage experience that I don't need to get from my employer. Spoiler alert, you probably already read it, but it's Fidelity. So actually, when you go to Fidelity and say open an account, you can open an HSA account. And I actually did it just before recording this show. It took me all of about 45 seconds to click through and sign a bunch of things that say, do you agree to this? And I linked my bank account, and Robert's your mother's brother. I can go ahead and start depositing funds. Then I use a traditional IRA account. Traditional IRA account, that's the money that is taxed going in. It's tax-free going in, I'm sorry. That is a culmination of my annual contributions to that each year, plus my past 401ks from other jobs. I've rolled away from those and put them into my traditional IRA. And then lastly, we didn't touch on these, but I do have an employer that does offer a 401k. And so I do have a Roth 401k, which is tax-free coming out, but taxed going in.
Yeah. So all I'll say on the health savings account, because we didn't really go into like what that looks like when you log in, but spoiler alert, it's going to look like an account. And functionally, you can do, and this is what I really like. I love HSAs. Is functionally you can do all that same exact stuff that you can do with the IRA. So I personally, I have a setup similar to what Sprocket said, but managing my HSA specifically is just such a cool, empowerment feeling. So basically, I keep a portion of cash in the account because that's the HSA that I have comes with a debit card that you can use to swipe, pay for medical expenses straight out of that account. So I keep on hand enough cash to be able to, buy whatever medical expenses we regularly have with that card. And then once the deposits that are going into that account go over whatever that spending amount is, the pinch spending amount, then I go ahead and I drop that into various ETFs, slow ETFs that might even be a little bit more conservative than even like the VTI or a VOO or anything like that, because that's just the freedom you have. You can invest it in anything you want. It grows cash free or tax free, and I start fairly conservative with it. If it continues to build, then I might start layering in some slightly more aggressive ETFs with it. But again, I'm really not trying to make that in a trading account or anything like that. Just a steady, better than savings, average rate of return is all I need, because ultimately that's just a holding storage for cash that might be needed in the blink of an eye. And so I don't want to get too crazy or too risky with it, because slow and steady is the name of the game there. So that's essentially how I manage my HSA, and it works out very, very well.
And that brings us to the end of this week's episode. Hopefully, you grabbed a couple of nuggets out of here, and hopefully, we kept it simple enough so that you can really understand that there's nothing magical to starting your retirement savings. And it really is, if you can open up a bank account, you can open up a streaming account to get your Netflix or your Hulu or whatever it is. If you can do that, you can open up an IRA account and you can put money into that. You can open up an HSA account. And just divide out how much you're going to put into a year, make that contribution each paycheck, $50, $20, $100, whatever that happens to be. And it really, really is not hard when you got the money in there. You can just log in, you pick a ticker symbol to buy. If you're not even sure what ticker symbol to buy, go with these targeted retirement funds and just say, hey, I want to retire in 2050. Pick that fund ticker symbol and put in your $50, your $100 a week, whatever that happens to be. And that's it. Set it and forget it. Let it plod along over time and grow. We'll grow tax-free in there. And you will be in a better place when you retire. And you'll be one of those people that says, who's happy on a Monday? A retiree. So if you're, aside from that, back in the trading world, I hope you guys find some exciting things to trade out there in the market. Volatility is kind of creeping up, kind of fading away. It's just kind of bouncing all over the place. Market is kind of approaching on all-time highs yet again. So where do we go from here? We're going to continue up. We're going to get a tracement. If you're in these funds, who cares? You're just plodding along. But if you're not, and you're also trading in a brokerage account, good luck out there. I hope you find something interesting. And remember, think outside the block.